Well, investors took a deep breath after heavy losses yesterday. We did get a snapback rally today, but it did fade near the end of the session. In all, we got back about 40% of what we lost yesterday. Unfortunately, that wasn't enough of a boost to change the opinion of the market forecast technical indicator that we use to set our posture during these videos. We remain bearish across the board. So we're going to look at all of the different movements from a charting perspective during today's video. Then we're going to look at another bearish trade setup. The last three bearish trade setups I've done have been in the healthcare space. Tonight, we're going to take a look at one within the consumer discretionary space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 14th, 2019. First of all, if you're new, welcome aboard. Remember to go to our YouTube channel, click subscribe, and while you're there, go to our description area to sign up for our email distribution list. We're also heavy users of Twitter. We thank all of you that engage with us on that social media. Remember, you can follow me at Brandon Van Zee. And then lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. And as a reminder, this is just a forward grid where we're looking at the four major U.S. equity indices. Each one of these charts is 3 months in length, and each one of the candles that you see represents 1 day. Now, the chart in the upper left is the S&P 500, which is the most widely tracked equity benchmark on the planet. So that is kind of the default view that we would go to first. And you can see that we were up about 0.8%. So that was actually the worst performer of these four charts in front of us. The best performer today was the Russell 2000. Notice the Russell 2000 was up 1.32%. However, if you look at the candles yesterday, the Russell 2000 got demolished yesterday. In comparison to the S&P 500, and so it probably makes sense that it's gaining back a little bit more as well to make up for that. So as we look at these charts, it's important to recognize that there has been some changes that have taken place here recently. First of all, notice that the background colors of the charts have switched from this lighter pink color to this darker pink color, and that actually happened yesterday. But as a reminder, that occurs when the green line on the market forecast indicator, which you can find over on the Thinkorswim platform, that green line is known as the intermediate line, and that's kind of our default posture setting tool that we use. When it is falling between 80 and 20, we consider that bearish. But when it's falling between 80 and 50, we would consider that weakly bearish. When it's falling between 50 and 20, we would consider that strongly bearish. And so when that occurs, when that green line falls below the 50th percentile on that graph there, it does change that to a dark pink background. So notice that all four of our charts now have what would be known as a strongly bearish posture at this point. In addition to that, it's worth noting that all of our different indices here also have red moving averages. And the way that a moving average will turn red is if price is below a falling moving average. So notice, like as an example up here on the S&P 500, prices were below that moving average for much of the last week. But at that point, the moving average was still going up. So that's why the moving average was yellow. Now that the moving average has suffered a little bit more wear and tear, it's actually falling just a little bit. I know it looks kind of sideways to the naked eye, but you know, if you examine the numbers, it is falling just a little bit. So now that we have the moving average itself falling and prices below it, the moving average is coded with our special think script that we make available to our premium members to turn that market or that moving average to a red color. So again, notice that is the case with all four of these indices as well. So things are not necessarily looking so good. One other thing that I would point out that's somewhat new is that the market sentiment line on the NASDAQ is now known as bearish. Now, we had been bearish on some of these other indices. Notice that in the orange label here, it says the market sentiment was at 78 and falling. This one up here for the Dow Jones was at 70 and falling. This one down below here for the Russell 2000 was at 63 and falling. But remember, when one of these lines, whether you're looking at the market forecast lines or the market sentiment line, when they fall out of the upper reversal zone and fall below 80, that is what would trigger, a quote-unquote bearish posture from that line's perspective. And remember, the market sentiment line is the longest of those 4 lines. It goes back and tracks the most data out of those 4 lines. So you could think of it as kind of the least sensitive of those because it does track so much data. The green line, which is what we typically will use most often during these videos, is known as kind of the intermediate time period. So think months there. The blue line is, thinking in terms of weeks, and then the red line is just days. And so anyway, that is somewhat new as well. And as a reminder, for those of you that have access to this charting setup, chart 4B, you can just right click on the chart and then go to maximize sell. And you'll be able to see this a little bit better here as well. And you can kind of see that orange dotted line now just barely below that upper reversal zone, kind of where I'm pointing at with my mouse down there. So anyway, be aware of that as well. So there have been some fairly significant changes is I guess the point of all of this. Remember, that won't always be the case. When we do a daily video like we do, a lot of times, the charts will look pretty similar to the way that they looked the day before. But with enough price movement like we've seen here in the last week, we are starting to see a bit more wear and tear across the board. But the key takeaway is, despite today's rallies across the board, we do remain with that strongly bearish posture. Let's go ahead and take a look at our next chart setup now, and this will be chart 4C. And this will be our 3 green arrows chart setup, or in today's case, 3 red arrows chart setup, because as you can see here, the background colors of all of these charts right now have that pink shading. And right here on chart 4C, this is what we would use for trend trading purposes. Remember, I teach a top-down trend trading class on Mondays. We actually just had a fairly big change in our risk management technique that I introduced this last Monday for those of you that want to go back and watch the recording if you are premium members of Market Scholars. But anyway, this 3 green arrows chart will help us identify whether trends are bullish or bearish or somewhere in between. Right now, price action is kind of showing us more sideways type of action if you're looking at, let's call it, the last 3 months, like all of these charts are. Now, obviously, the last week or two has been very bearish, but if we look back over the last 3 months, prices have largely been kind of tracking sideways. As just one example, you can see the Russell 2000 was almost identically in the location that it's at right now 3 months ago. You can see that, 3 months ago would have been the 14th of February. And the closing price was $15.45. Well, guess what? It's $15.43 today. So 3 months have gone by, and essentially this entire index of 2,000 stocks is down 2 whole points. That's it. So price action is telling us right now that we have more sideways type of behavior, or you might want to think about it like it's more of a question mark. You just don't know whether momentum is pushing stocks up or down. And remember, sideways markets can be excellent markets to be thinking about doing things like selling iron condors in, or other neutral based option strategies. On the other hand, if you're looking for momentum to carry your trades either up or down from a stock perspective, then that's where you're trying to look for more of those trends. And unfortunately, we are not in great conditions for that right now, because as an example with the S&P 500, yeah, it's true we're still up on a 3-month basis here, but because this pullback has been so extreme over the last couple of weeks, right now we're still in wait and see mode before putting on new types of big trend trading bets to the upside, because we don't know how long this wear and tear in the market's going to last. A lot of it is being driven by geopolitical concerns regarding China and the United States trade policies. And so, if that continues throughout the summer, we could very well continue to grind lower in the stock markets. On the other hand, if there's a resolution, we could pop right back up. But the point is, right now, we find ourselves in this wear and tear type of a market to the downside. And if you are buying stocks right here in the hopes that they rebound, hopefully you're doing so based off of different valuation measurements or different things where you're becoming a long-term investor. Because if you're a momentum-based investor, or trader would be a better way to phrase that, right now it's just a guess, and you're rolling the dice that a trade deal will get done, because right now the path of least resistance is to the downside. And remember, it's been a while since we've seen that. And remember, if you don't know how to kind of address that, you can use something like a 30-day moving average to kind of make that determination. The path of least resistance for 2.5 of the last 3 months was to the upside, as you see that green moving average, pretty much that entire period up until here recently. Then we went to neutral in yellow, and now just recently we went to red. So that moving average is telling us that things are changing here, and the path of least resistance may no longer be to the upside like it was in the past. So you just have to be a little bit more cautious on your trend trades if you are planning on taking them to the upside in this current market. All right, as we look forward to our longer term chart now, this will be chart 4D. And remember, this is our 1040 crossover method chart. These are the same 4 equity indices we're looking at here, but each one of these charts goes back 3 years in length, and each one of the candles represents 1 week rather than 1 day. Well, one of the things I brought to your guys' attention last week was the fact that on the Dow, we started to get this red arrow showing up above the chart. And I was explaining that that red arrow was basically signifying that price was below the orange moving average on this chart. Now, that orange moving average is a 10-week moving average. Remember that the background colors of the charts will turn from green to pink if the moving averages themselves cross over. We're not there yet. We're getting awfully close, as you can see down below here on the Russell 2000. Remember, that was the most recent one to finally switch to a bullish posture, so it was the one that didn't have a whole lot of separation between the moving averages to begin with. So it does make sense that if the markets start rolling over here, that it's likely going to be the Russell 2000 that will go bearish, death cross first, because there's just not a lot of leeway there, whereas we had more separation in the moving averages in a lot of these other charts, as you can see. But anyway, it's not just the Dow now that is showing us that red arrow like it was last week. Now, if you look at the other 3 charts, notice there's a red arrow over this week's candle for the S&P 500. There's a red arrow over this week's candle for the NASDAQ composite, and there's a red arrow over this week's candle for the Russell 2000. So all 3 of those joined the Dow by showing us some deterioration in price action. And remember that you're not going to see a moving average crossover unless price starts that process. Now, just because we have price below a moving average doesn't guarantee that it's going to continue to go lower, but every death cross on this 1040 crossover method will start eventually with price closing below the 10-week moving average. And so whether this leads to a bearish crossover or not in the moving averages is anybody's guess. But right now, our senses are heightened a little bit because the action is kind of, planting the seed for that possibility in the weeks to come. So let's keep our eye on that. And as always, David and I will keep you posted once we do recognize any of those death crosses if they are to occur here in the future. All right, let's now take a look at some of our 12 grid analysis. This first set of 12 grids is going to be our intermarket analysis 12 grid. And remember, when we're looking at these 12 grids, the background colors of the charts will tell you whether the intermediate term posture of the market forecast technical indicator is signifying a bullish posture or a bearish posture. And so this first set of 12 grids here are going to be things that are outside of the stock market. And so you'll oftentimes have more of a mixed bag here. I have a feeling once we start looking at the stocks in terms of either the foreign stocks or the sectors in the United States, we're going to see a lot more pink charts. But here on this first set of 12 grids, you actually see quite a number of green charts on the board. Some of them look better than others from a price perspective. And the ones that I think look a little bit better are probably the bond-related ones. In particular, if you look at TLT and BDNX, or I'm sorry, BNDX, that's a foreign bond ETF, BNDX. Notice that that's actually breaking to 3-month highs today. So, if you ever hear somebody say, well, nothing's working in the market right now, point them to that. That's actually hitting multi-month highs. And remember, money changes hands, and so sometimes money leaves the stock market and it needs to go find a home. Sometimes it finds a home in cash, in a money market account somewhere. Other times it finds its way into commodities or into bonds or other areas. Even Bitcoin's getting a little bit of a bounce here this year. So anyway, remember that a lot of times money does move and changes hands from one place to another. So if you're seeing that, the particular market that you're focusing on is starting to really struggle, perhaps look at other markets around you where that money could be drifting over towards. And you are seeing that foreign bonds are starting to look reasonably attractive on a trending perspective. TLT also looks pretty impressive. However, it's not quite as strong in my eyes as BNDX. And the reason for that is twofold. First of all, notice that the moving average colors are different. So the moving average color on TLT is yellow because the moving average is rolling over while price is above it, whereas with BNDX, you have price above a rising moving average, so the tip of that moving average is green. So from that perspective, it's a little healthier. In addition to that, just simply looking at the price action all by itself appears like things are a little bit healthier with BNDX as well. The reason for that is, as I mentioned a moment ago, we basically closed at the highs here at 3-month highs with today's session. Whereas when we look at TLT, notice we actually pulled back a little bit today. So TLT was down today as opposed to BNDX being up, but the placement of where our candle is in relationship to its recent trading history is also important. Notice that here on March 28th was the high point for U.S. government long bonds. We have not achieved that price high since then, whereas with foreign bonds, we are up and over those levels. So anyway, keep your eye on foreign bonds. I know it's probably not the most exciting or fun place to be hanging out, but nevertheless, it appears to be working in this market environment where it feels like not a whole lot is working. Also impressive was REITs. You'll notice that VNQ had enough of a bounce here today to push it back above its moving average. So that's worth noting. In fact, in my dividend growth investing class that I taught for my premium students here earlier today, we actually concentrated on the REITs sector. So we had the conversation of, why you shouldn't be using earnings per share to evaluate REITs. You should be looking at, adjusted funds from operations and different things like that. So if you are a premium member of Market Scholars, feel free to go back and check that recording here if you have an interest in that topic. Other things to be aware of on this 12 grid here is that we did have a nice bounce finally out of ag commodities. You'll notice down below, ag commodities had a pretty nice move right there. But the bad news is it remains in a significant downtrend. So I don't know if I would really be overly excited about this unless something starts entering into the news flow that suggests that China is going to come to terms with the trade deal and they're going to end up buying gobs and gobs of crops from the U.S. farmers that might drive prices higher. But right now that would be a bit of a Hail Mary. So you got to be a little bit careful pressing your bets in a situation like this. But for those of you that might have bought here recently and now have regretted it, perhaps today is a day that you can get bailed out to a little bit. You'll notice that the U.S. dollar was up nicely today. Interestingly enough, the U.S. dollar has actually carved out a pretty strong trend to the upside over the last 3 months. This is, one of those instruments that we talk about in nearly every Market Outlook video because of its importance of various securities out there, whether you're talking about commodities or foreign stocks or what have you. And, more times than not, we've been talking about the strength in the U.S. dollar. And it continued here today where you needed it to. In other words, if you're playing this as a trend trading, you're looking for higher highs and higher lows, this thing came down and touched the moving average here the last couple of days. Notice that it came right down to this area where it put in a double top on, it was March 7th, and also here on around, April 2nd or thereabouts. And so that theory of old resistance with that double top becoming new support right here yesterday was useful for technicians that are out there. And we did get a nice bounce off of those lows yesterday. We closed at the high of yesterday's session when it was so ugly for the stock market. And then we continued that rally in the US dollar here today. So that looks like it saved its uptrend. It's still intact. While the chart background is pink, I would assume that if it has another day or two of upside action like it did today, that chart background will turn back to that green bullish color there. Also, the news has certainly been surrounding the VIX this week because of all the fear that's entered into the marketplace all of a sudden. Be aware that the VIX did fall about 12% here today, but still remains at a fairly elevated level of 18. And so that kind of gives us the impression that, this market may not be done going down yet. Another thing that you would look for is long lower shadows in the general market. So if I just flip back to the chart 4B here real quick for this conversation. Notice that we don't really have any long lower shadows yet. So that's where I'm a bit skeptical of today's bounce higher. Unfortunately, I wish that wasn't the case. I generally want the stock market to go higher whenever possible, but you gotta call them like you see them. And right now, I don't see long lower shadows there in terms of the candlesticks, and where we've flushed out a lot of the weak hands. Was it ugly price action this week? Yeah, but was it kind of did it feel like capitulation? Not necessarily, not from my perspective. So I still kind of approach these markets quite cautiously as it stands right now. And the VIX is kind of telling us that same thing. Let's go ahead and take a look at chart 4F now. This will be the foreign stock markets 12 grid. Now, again, as I mentioned here a little bit ago, I expected to see a lot of pink charts, and I'm receiving it. Clean sweep all across the board. All 12 of these foreign stock markets have pink charts. In other words, they are considered to have bearish postures according to the market forecast intermediate term line. And so, as always, the charts are going to look slightly different from one another depending upon what's happening in the various countries out there. But of course, some of the more noteworthy, countries here recently have been revolving around the trade news, and China is front and center in that conversation. So this chart in the upper right-hand corner is FXI, and that's the ETF that we use as the proxy for China. Now, there are a lot of other China ETFs out there that you can use, and there are some that focus on, the domestic market, or some of them focus on Hong Kong. So there's different ways to look at it, but this FXI is oftentimes used just because it tends to be one of the more liquid instruments that represents kind of the China, investment idea that's out there. So as it stands here, we actually had a pretty decent rally in China. We had FXI up 1.6% today. So remember, that was more than all of the 4 major equity indices in the United States. But we also have to keep in mind that China's stock market has fallen much more rapidly than the US one has as well. In fact, this really started since topping out on April 17th. It's been basically a one-way train wreck to the downside. Whereas if we were to pull up, let's say, SPX here, notice that it topped out on May 1st, right, on this candle. So remember, April 17th and May 1st are quite a long ways away from each other in the world of shorter term or active trading like we talk about in these videos. So China did top out a lot faster or a lot sooner than the S&P 500 did. And you'll still notice that despite it being a really chaotic and sometimes painful couple of weeks that we've had here in the United States, we're still up 3.23% over the last 3 months. Whereas if I flip it back over to China now, you'll notice that China's actually down 3.7% over the last 3 months. So anyway, there's been a lot more pain overseas, and I know it doesn't really help you feel any better if you reside in the United States. You're still taking losses like so many other people, but it is true that we've actually had it pretty decent so far here in the United States, and who knows if that leads to any sort of worse conditions going forward. But right now we do know that China remains kind of a hot button issue. And right now it looks like the trend continues to be to the downside in a very significant way. Remember, it was just a couple of weeks ago we were talking about this candle right here where it broke down below these support areas. And it's even, it's lost a ton of ground even since those levels. So right now, it's a pretty dangerous game to play. Remember, sometimes people will get excited about oversold cluster signals and kind of use that as a way to play a contrarian mindset, a reversion to the mean type of a trade. But we haven't even received those yet in China. We did get some in India here. Notice these little green dots showing up on the chart. Those haven't really worked out that well here so far, but we didn't ever get them in China. We did get one down here on South Africa. That one worked really nicely, but that was way back in, let's see, it was March 14th. So keep that in the back of your mind as well. Some of you are saying, well, geez, China can't keep on going down forever. It's got to be a buy one of these days. If that is your mindset, then perhaps you'll wait for one of those oversold cluster signals to kind of give you a heads up that maybe some of the worst of the selling is now over. Other areas of focus here, there were some nice bounces out there in terms of, today, one-day performances. We did have India up over 2%. We also had Russia up over 2%. So those were healthy bounces, not enough to change the posture, but still good bounces. And then also, I would say Mexico was rather impressive. It wasn't as big on a percentage basis. It was only up 1.18%. But I do like the way that it has been kind of holding the line here for the last 4 sessions or so. Notice that it's really it's actually up just a hair over the last 4 sessions, and you can't say that for stocks in the United States as an example. And so Mexico appears to want to be trying to find some sort of a bottom in this area, and we'll see if they'll be able to do that here in the coming sessions. Let's now take a look at our next 12 grid, and this will be our U.S. sectors 12 grid. All right, so you should see a theme here right out of the gate. You should see it, immediately, and that is your green charts are on the bottom. And remember that the way that I set this chart 4G up for those of you that are premium members is I put those defensive sectors on the bottom in terms of the sector business cycle that generally exists out there. And when times get chaotic like they have been recently, where there is some more relative strength, not always absolute strength, but more relative strength, is typically in the more defensive areas, with the mindset that if things really start spiraling out of control with the economy, people are still going to pay their electricity bill, as an example, with the utilities, whereas they might give up the idea of buying a new car or something like that. So you tend to find this type of behavior when we have chaotic weeks like we've had here recently, and that's shining itself through here with this particular chart setup in the green charts with those defensive areas. The staples have been pretty impressive to me. Notice these other charts here, like utilities is kind of sideways, and real estate is largely sideways as well. Whereas when you look at the staples chart, it has more of a feel of an upward bias to it. You can see that moving average on the staples has been green this entire 3 months, with the exception of one single day right there where it was yellow for a brief moment in time. But otherwise, that has been a very consistent green moving average there, and you haven't seen that consistency out of the utilities and real estate. I know that Coca-Cola was upgraded here today, had a nice little pop based off of that. But I've also been noticing, we talked about Hershey's here in one of my classes recently doing quite well, and Diageo has been doing well, and Procter & Gamble and Kimberly-Clark, and some of these more boring types of names are where investors tend to kind of hunker down in chaotic moments, and they usually kind of stray away from more of the cyclical areas of the market. You'll notice that all of these other charts are red to various degrees. Some of them are still somewhat closer to the moving averages, like the financials are still pretty close to the moving average, whereas there are others like energy that has a wide separation between it and its moving average. It's really fallen out of bed, as has the materials. But as you can see, most of these were up here today in this rebound type of a market we had, with the exception of the utilities. But you have to remember that yesterday the utilities were actually up when the stock market got demolished. So kind of reversal of roles there, where today the stock market was up and utilities went down a little bit. On the sector selector, so remember I produced this on Fridays, I did want to point this out as well. Notice that one of the big changes on a week-over-week basis with the rankings here was what's happening with the consumer. Notice that the consumer staples, what I just referenced here a moment ago, those Coca-Colas and Procter & Gambles and Hershey's of the world, they went from the 7th rank up to the 3rd rank in a week-over-week basis. That's a huge jump in terms of ranking. Typically, you only see movements of, let's say, 1 or 2 moves. From 7 up to 3 is a good 4 moves right there to the upside, or improvements of 4 placements to the upside. So that definitely caught my eye. In addition to that, it's equally noteworthy that discretionary fell out of bed. Now, not quite as dramatic, but still pretty dramatic. It made 3 moves to the downside. Last week, discretionary was 5th. It fell all the way down to 8th. So consumer staples getting some love from investors, consumer discretionary falling out of bed. And that can make some sense depending upon the different stocks as well. Typically those consumer discretionary names are oftentimes retail oriented. So think about apparel retail or jewelry or different things like that. And a lot of times, that type of stuff, even electronics and different things like that, stuff gets made outside of the United States, gets imported into the United States where it's then sold by retailers. Well, if there is a trade war, you can imagine that the cost of importing that stuff, if you're a retailer in the United States, is going to become more expensive, and therefore your margins might get squeezed in the future. So I think investors are starting to think about that a little bit more so, and not just brush it aside like they might have in the past. So that's the big takeaway from the sector selector over the week. Money gravitating towards more of those defensive staples and moving away from more of the cyclical discretionary area. Also, thanks to everybody who clicked like on the Market Outlook video. I appreciate all 103 of you. You guys are doing a great job with that. And we've got some great classes coming up tomorrow. David's got his options inventory class at 11 a.m. Eastern time for those of you that are premium members. And then I've got my Strategy Lab swing trading class tomorrow at 2 p.m. Eastern time. All right, let's talk about our trade application example now. And for this, I'm going to come back on over here to chart 4A. And I mentioned in the intro I wanted to focus on the consumer discretionary space. Remember, my last 4 trades in these videos have all been bearish as we've been starting to see this deterioration in the market, but they've all been concentrated on the healthcare space. So I didn't want to kind of load the boat too much in one single sector, so I want to spread out my bets a little bit. And today I wanted to look at LOPE. This is Grand Canyon Education. LOPE is the ticker symbol, which I believe is their mascot as well. Somebody told me along the way, maybe the antelopes. But anyway, this is a private college or education company. And as you can see here, it actually reported back here in February what appears to be a spectacular number, because that stock went from about $96 all the way up here to about $118 in one single session. It then put in that overbought cluster signal and basically went sideways for a long period of time. So everybody that got really excited about this big move up but was disregarding that cluster signal probably was disappointed that it didn't end up continuing to go up. So unless you were already invested in this one back here, you didn't really get a chance to benefit from it, because you likely would have bought it on this candle and then you saw mostly sideways trading action. Well, it did eventually start curling up a little bit, but still not a big percentage move. Remember, it was already at 118 over here. It eventually did get up to about 123 at its peak value. That was back on April 26th. But since then, we've seen deterioration in that chart. And that's not picking on these guys specifically. I mean, a lot of charts look like this. But the reason I wanted to kind of focus on this one today, as opposed to some of the other trades that I was looking at, was the fact that this one did not get its dead cat bounce today. Right? It was down over 1%. Now, I didn't look at it. I don't know if there was some sort of news that was specific to this company that was the reason behind that. But nonetheless, it did catch my eye, because the vast majority of stocks did close higher today. They didn't make up for all of their gains they lost, or all of their losses from yesterday, but most of them did close higher today. This one did not. And in doing so, what happened here is you'll notice that the background color of the chart went from that light pink color to this dark pink color. And notice this is the first time on this 3-month chart that LOPE has had what we would deem to be a bearish posture from an intermediate perspective, according to the market forecast technical indicator. Now, there are different ways to try to take advantage of bearishness out there. Some of you might choose to short stocks. Now, of course, you can't short stocks in IRA accounts, so they are a little bit more prohibitive. And sometimes smaller companies like this one might not have shares available for you to short through your broker anyway. But another way to take advantage of bearish conditions is through the options market. And so what I thought we would do today is a long put spread. You can see I've got it loaded up down below here on my Thinkorswim Paper Money platform already. And what I'm choosing to implement this idea with is the June monthly contract. So those are the ones with 38 days until expiration. And I'm using the 120 strike as the bought strike here and the 110 strike as the sold strike here. A lot of times when we do debit spreads or long vertical spreads, we choose one that's in the money to buy and we sell one that's out of the money. So since this one is at about $114.29 right now, the at the money strike would be the 115. So, one in the money would be your 120 put. That's what's driving the trade. And then when you're selling one out of the money, that would be the 110 put here. And what you're doing here is you're basically trying to help finance a bearish trade. In other words, some of you might choose just to buy a put on a stock that looks like this. The benefit of buying a put is that you're not capping your gain potential, assuming that stock is about to fall a long ways. On the other hand, when you're buying puts, they can become quite expensive, particularly right now after we've had a big bump higher in the VIX. And so one way to kind of offset the costs of purchasing that put to take your bearish, theory into action is to sell another put against it to somewhat offset those costs. So if the 120 puts are expensive, then theoretically the 110 puts are also expensive. And so you're kind of making that back to a degree. Now, that's the good news. The bad side of that equation is that if this stock really, really fell apart, let's say we wake up 2 months from now and it's a $90 stock. After $110, the way this trade is set up, we don't really benefit any more than that. So that is the downside. This is not kind of like one of those home run types of trades, but it can still produce reasonable results. Notice that this would be known as a $10 wide debit spread here. And we have to pay out of our pocket $4.80 for that. So basically, if you just want to round and think in terms of very simple math, we're paying about $5 to access this $10 wide spread. In other words, we're paying $5 for the opportunity to make an additional $5 because the spread would be worth $10 at its maximum. So if we're paying $5 for something that could eventually be worth $10, then you have the ability to basically double your money, right? $5 in order to make $5. So that could be somewhat appealing, but it does require a directional mindset. In other words, a lot of times David and I will show you in these videos how to do bear call spreads. Those are credit spreads where sideways price action is acceptable after placing the trade, even if we were bearish on them. This one is suggesting that we would need the stock to continue to go down. We can't just have it go sideways, otherwise we're not going to make a fair amount of money on it. However, one thing I will point out with this one is that if you get your calculator out here and you take 120, which is the strike on the bought one that we're doing for the put, and we subtract out our debit of $4.80, our break even is at 115.20. Notice that the stock is already at 114.29. So we've got a bit of a head start there already, assuming these prices will hold. Now keep in mind, this is not the most liquid stock on the planet, so it is a good practice stock, but might not be a great fit for those of you that have really large accounts where you need a lot more liquidity. But I will put it in, nonetheless, confirm and send, and ship that off, and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here tonight. Good to see a little bit of a bounce back in the markets here today, but unfortunately, I'm just not sold that the downside selling is over with quite yet. So we'll stay tuned to that as we always do. Of course, David will be back with you here tomorrow in case things do change. But as always, if you get value out of these daily videos, make sure you go over to Twitter, click like, and retweet. We really appreciate that. Have yourself a great rest of the day. Best of success with your trades and your investments. Goodbye for now.